It's the fourth day of our business journey this week. Good morning and welcome to Business Morning Live on Channels Television. I'm Ini John McCoy. Well, let's start off with global oil prices and the drivers. Prices fell today for a second straight session as demand concerns outweighed tight global supply after U.S. government data showed tepid gasoline consumption during the peak summer driving season. Brent crude futures dropped 33 cents to $106.59 a barrel after slipping 0.4% in the previous session. U.S. West Texas Intermediate crude futures fell by 48 cents to $99.40 a barrel, and that's following almost 2% drop yesterday. Oil prices have been volatile as traders have had to square tighter global supply because of the loss of Russian barrels following the country's invasion of Ukraine, with recessionary worries that could weaken energy demand. Concerns over Libya's supplies have also eased as the National Oil Corporation said that crude production had resumed at several oil fields after lifting force majeure on oil exports last week. Still, one of Canada's major oil export arteries, the Keystone Pipeline, was operating at a reduced rate for a third day yesterday. And back in Nigeria, not very good times for bread lovers as bakers in the country are set to embark on a 4-day warning strike beginning from today over high costs of baking materials because of the hike in diesel price. In a statement that the bakers issued under the aegis of the Premium Bread Makers Association of Nigeria, they asked the federal government to stop charging 15% wheat development levy on imports. Meanwhile, the president of PBAN, Emmanuel Onora, said that it is also requesting that there'll be a downward review of the 154,000 naira penalties charged to bakeries on late renewal of certificates by the National Agency for Food and Drug Administration and Control, NAFDAC.
The government must show concern because as small businesses, we are the drivers of the economy. If all the bakeries go extinct, I mean, bread is a staple. It's a food that every Nigerian wants to have on their table. And if it is dried up, then it's going to exacerbate the current challenges we are facing in the country. And we don't want that to happen. And then 2, 3, NAFDAC as an agency, as premium bread makers, we've written NAFDAC severally and our sisters association. Do you look at this? You want to register a pack size. NAFDAC will charge you 30,000. But when they want to renew it, they don't even give you any prompt. They don't give you any prompt, maybe like a week that they do in auto reg. The next thing is when you are going to renew, NAFDAC will say you should pay 154,000 for a pack size. Where is that done? We've written to NAFDAC professional, Prof. Adeyeye. Nobody answered us. We've reminded them, nobody answered us. How can a country run on that kind of impunity where government agencies don't even want to interface with the associations or the industry they are regulating? They are our regulators. And then 4, there's multi-sectoral, multi-agency regulation of bakery industry. SON, NAFDAC, every agency wants to regulate the industry. They think there's a cookie jar for everybody there. They bust into the bakeries sometimes without notice, and all they're asking for is the same thing. Food handlers test, water analysis test, hygiene and all that. All of them are doing the same thing. Why are all of them, why are everybody coming to regulators? It doesn't work that way.
On Tuesday, there was the 206th Monetary Policy Committee meeting. It was concluded on that day with 11 members unanimously agreeing to hike rates. 6 of them proposed an increase by 100 basis points, and this was adopted. Well, this is the second consecutive hike in rate, moving the monetary policy rate from 13% to 14%. Needless to say, it's going to have a widespread effect on everyone, including yourself and myself. Let's discuss the possible impact on investment and relative issues with Dr. Omobola Adu, investment research analyst with AfriInvest. Good morning, Dr. Omobola. Thank you so much for joining us.
Good morning. Glad to be here.
All right. So I think one of the major questions that's coming out of this hike in the rate is, do you see the hike in this MPR taming inflation?
Yeah, so thank you for that question. I think to start with, right, we have to realize that inflation is not just a monetary factor. It's also driven by cost-related pressures. And by the time you consider what has been happening globally and also in the Nigerian economy over the last couple of months, we'll see those pressures in terms of cost-driven inflation. And so by the reason of those factors, you don't expect to see a significant impact of the interest rate hike on inflation. I mean, in Europe, we've seen the global energy crisis that have caused oil prices and energy prices to skyrocket. Over the last couple of days, we heard potential news that PMS prices could be adjusted upwards. And by the time you look at all these things together, these things are basically outside the control of the CBN, right? The monetary policy to really has no impact in driving down cost-related pressures. And by that extension, you would expect that prices might not adjust downwards in the near term. Also, if you factor into food inflation is currently around 20%. Most of the staples that we have out there that consumers usually purchase over the last couple of months, most of them have increased over 20%, well above the headline inflation rate. And these are the factors that the monetary policy is relatively ineffective in trying to adjust or to influence the direction of prices of those energy commodities and food prices. Also, if you look at it from a historical angle in terms of the last MPC hike, which was in around May when they did about 50 basis points, we still saw that inflation remained resilient. Just highlighting the fact that Nigeria's inflation is more or less structurally driven. Over the last 3 months, total money supply in the economy has increased by a cumulative growth rate of around 3%. System liquidity has remained tight. Just to bring to the focus that in the economy, the monetary pressures are not so much prevailing compared to the cost factors. And so that tells us that in terms of impact on bringing down inflation, we might not see a significant impact by the decision of the Central Bank and the Monetary Policy Committee.
Yet the central bank governor he was very direct when he said that as long as inflation keeps surging, the MPC will most likely keep increasing the rate. And so there's this fear of stagflation if rates keeps going up and then it keeps dwindling manufacture and outputs on the other hand. So how real is the fear of stagflation if, as the central bank governor says, rates just keep going up because inflation would not come down?
Yeah. So if you just go back to 2016 and the more recent economic challenges we've had, we've basically had a situation where unemployment is going up, inflation is high, and output growth remains weak. And so this situation is not something that is new. It's something that is common with the Nigerian economy, especially once we are faced with external pressures like we are right now. Unemployment rate by available data shows that it's around 33%. Inflation, as we know, is around 18%, and we expect it to move up to around 19% for this current month. And so fears of stagflation, we're already experiencing that already. I mean, in terms of output growth has remained weak. And by the time we look at this impact on a broad basis in terms of what it means for the economy, it shouldn't be surprising if we see slower growth rates in real terms. So basically, when we are looking at GDP or output growth for the economy, right, the higher the cost pressures or the higher price levels are in the economy, you expect that by the time you deflate the GDP in real terms, you should expect weaker or slower growth, and that just confirms the stagflation episode that we believe we are likely to continue to see in the short to medium term. So this, in terms of implications on the economy, when you look at the interest rate hike and likely implications on businesses, the first angle you can look at it in terms of cost of borrowing. So because of the adjustments in the benchmark interest rates, we expect interest rates on other financial assets, including loans and borrowings, should also move in similar direction. And for businesses, in terms of expansion plans, higher borrowing costs means higher interest expenses that you have to pay, which could then lead to a situation where companies might need to cut down on expansion plans or project expansion plans. And in a way, that also affects the real economy, because the economy won't be expanding as it should be. And when you look at that and bring all of that into context, we're already having a situation of stagflation there.
Wow. So, I think you've already talked about it, the issue of investment. But let's look at the foreign direct investment. Does this help in any way?
Yeah, so speaking of foreign direct investment, I'd like to speak to it in terms of two perspectives, looking at it from foreign portfolio and foreign direct investment, right? Just to give a bit of context, as at Q1, total capital inflows was around 1.6 billion, the lowest over the last 3 years. Foreign direct investment printed around 115 million thereabouts. And in terms of looking at how it would attract foreign investors, while interest rates are a good thing in terms of, you get your interest income on that. But for foreign investors, it goes beyond interest rates. So you have to look at FX policies. You put your money in today, how likely are you going to be able to get it out assets when you need it, and at the current or fair market price. And in terms of the interest rates movement, this is more of a concern for the foreign portfolio investors rather than even the FDIs. The FDIs will be more interested about the state of the economy. They'll be interested about the risks of the economy and these foreign policies. Because when you're making an investment, if you're having a horizon that, you want to come into this country and live probably within the next 5-10 years, you want to have an idea of what the exchange rates would be after that period. But looking at our current FX policies, is a bit difficult for the FDIs to be able to guarantee themselves that by the time we decide to exit this country, this would be the likely exchange rates. And so because of all these issues, and looking at we're also in a pre-election period, some of these risk factors will be at the top of the minds of the foreign direct investors. And if we even want to look at it from the portfolio angle, just like I mentioned earlier, in terms of the FX policy restrictions, we know that there has been issues with dollar shortages over the last couple of months. And so you are more or less concerned that if you convert your dollars today to Naira, how likely are you going to get it out at the fair market price? And so these are some of the issues that foreign investors will be pondering. And by that extension, in terms of foreign direct investment, even though we notice a marginal improvement in Q1, we don't expect it to return back to pre-pandemic or to levels that we've seen before, when foreign direct investment used to do roughly around 200 to 500 million on the average, while presently the best we're getting is around $100 million.
Yeah, well, it doesn't look like we can run away from that FX issue anytime soon. But let's look at the possible impact on the financial assets, at this time with this hike in the MPR. How do you see it playing out?
Yeah, so good question. In terms of this, first of all, we know that the monetary policy rate serves as a benchmark for other interest rates in the economy, and they have an impact on influencing short-term rates. So if past events has anything to tell us, the last MPC hike, that was the 50 basis points increase in May. We saw that translate to short-term lending, interbank lending rates adjusting, moving upwards, and by extension, interest rates in financial markets in terms of securities also adjusted, especially for T-bills. So before the 50 basis point hike, interest rates on 91-day Treasury bill were around 1%, 364 around an average of 4%, and after the hike, it initially moved up to around 2% and 6% respectively. But what we noticed was that after a point, it started to wane, or it became, it remained around those same levels, and there was no longer movement. Whereas on longer term instruments like bonds, the 10-year bonds, we noticed that they were less sensitive to the interest rates movement. And so we should expect to see that play out. We expect to see more interest rate movement on the shorter tenored instruments in the market. You also consider the fact that if you want to invest in the longer term bonds, you are basically taking more of a duration risk, and in terms of what you can do in terms of reinvestment. So by the time you look at all these factors together, you expect to say that for the shorter term instruments, you might expect to see interest rates movements more on those bonds. So that is the treasury bills and shorter term bonds. Whereas for the long tenured ones, we should expect to see them remain around the same levels. And even the short tenured ones, even though we expect to see upward adjustment, we don't see it playing out continuously. At some point, we expect it to also moderate and remain around a significant level. This is also when you consider cost of governance, right? Earlier, we noted that as at last year, the debt service revenue ratios were roughly around 87-90%. So this would also be at the mind of the DMO and CBN when they decide to issue these instruments also.
All right. Just before we let you go, some people have said that perhaps the MPC is doing this because that seems to be the trend. I mean, we do know the Bank of England, the ECB, the US Federal Reserve, everybody's hiking interest rate now as long as inflation keeps going up. And the result of not hiking it is what we saw. I think that was last week when the euro and the dollar were at par, which has not happened in 20 years. But do you think that there are some homegrown solutions? Because, of course, when we look at Nigeria, the Nigerian situation, we do know that supply costs, supply disruption is a major contributor to, the inflation that we see. Do you think there are some homegrown solutions, that we could use to tame inflation in Nigeria?
Yeah. So just like what I said earlier, in terms of looking at it from what the CBN can do, the CBN is in a way limited. That's because the inflation is largely driven by cost-related pressures. When we look at, like I said earlier, that money supply has remained muted, going roughly around 2%. If you want to now look at it in terms of policies, first of all, the CBN has largely not focused more on inflation, first of all. So in terms of bringing down inflation through adjusting the interest rates, we might say that there's a little bit of market skepticism concerning that. The CBN stance has mostly largely driven towards accommodating growth and other FX-related issues. So moving the stance now to focus on inflation will mean that they need to, first of all, build a little bit of credibility to say that, I want to manage inflationary expectations. And they hinted that in, like you rightly mentioned, that saying that they want to, that they'll be committed to increasing interest rates in order to bring down inflation. But in terms of looking at it for domestic policies, first of all, it has to do with more or less the coordination in terms of monetary and fiscal policies. And secondly, we also have to look at it in terms of making the Naira more attractive. And that has to that then goes down to our revenue diversification in terms of exports. We know that in terms of all revenue account for over 90% of our export earnings. So by that extension, we leave ourselves vulnerable to external shocks like we have seen. So in terms of looking at domestic policies, first of all, we need to get things right in terms of FX management. We also need to look at how we can boost the non-oil segment of our export earnings, which would then make the Naira more competitive and by extension help to reduce inflationary expectations.
All right. Thank you so much, Dr. Mobola Adu, investment research analyst with AfroInvest. Thank you for sharing your thoughts with us. Enjoy the rest of your day.
Yes, sir.
The hike in interest rates is not just in Nigeria. It doesn't look like any country has escaped this. But the case with Nigeria seems compounded with high import bill, top on the list being oil. And the worst hit at this time seems like the aviation sector. Aero contractors and Dana Airlines may not be flying for a while. Well, I think maybe we've heard that news, but we have Bolanle Agbaje, analyst with financial derivatives company, joining us now to help us understand some of the magnitude and how this could affect you. She's here in the studio. Good morning, Bolanle.
Good morning. Thanks for having me.
I missed you on Tuesday.
Yes.
But it doesn't look like a very good one for the aviation sector. 2 airlines.
Yes.
And already I don't think we have enough to cater for the demand that we have, and now minus 2 airlines.
It's a very essential industry, you know, and also very, very sensitive in terms of the fact that, you know, it's a very high cost operation. So in any case, when you have situations where costs are increasing rapidly compared to like the demand in terms of like revenue coming into the particular sector, it becomes tricky for airline operations because you're talking about labor costs, you're talking about fuel costs, you're talking about maintenance, which is necessary and essential to, you know, keep the flights running.
And I think they have a lot of documentation, licensing that they have to pay for.
Because it's a very high-risk industry as well. So it's usually, like, I'm actually happy at the fact that, you know, they've mentioned that they're going to actually, you know, stop to more or less, you know, take a step back, look at their cost and maintain their airlines as well, as opposed to keep flying and putting, you know, a lot of passengers at risk.
I think we heard that Dana had a near an emergency landing.
And you know, it's not necessarily good. It's not an industry that can be managed. You know, you have other manufacturers that, you know, can either tweak cost here and there, you know, actually maybe in the bread sector, for example, but when you're talking about aviation industry, there is no management. It's either this or that when it comes to, you know, the cost environment.
And of course, this is going to have a lot of effects.
Yes, definitely on transportation movement.
On transportation,
it will definitely
pricing.
Impact businesses, pricing as well. You know, cost environment would definitely increase further. And you're talking about inflation numbers already at 18.6. It's just going to make things worse, at least in the short term.
And the alternative doesn't look so attractive.
Yeah, road transportation. Yes, and rail. It's not necessarily, especially rail. We haven't really tapped into the potential for rail in this country. Road transportation, everybody's talking about the high risk, you know, because you have a situation where the security levels are already heightened. So traveling by road seems like a no-brainer for so many people in the country.
And the price of diesel and the price of aviation fuel.
Yes, aviation fuel is currently at about 780 naira per litre, in line with diesel, and that's just because you're not seeing subsidies in that sector. I know some of these airlines, the fact that they're pulling out, it means they're actually crying for help and maybe calling to the government to do something about the cost of jet fuel.
Wow. And so if this fits into inflation, and then
it will definitely be translated to, you know, the individual consumers.
To the individual, and then of course the CBN governor has said that once inflation is up, you can expect that
more hikes. Yes, and also, you know, the fact that most of these airlines are also heavily, you know, dependent on Forex as well. So Forex is a major issue. It has been, and it still it's still going to continue to be an issue for them because of the fact that, you know, we're seeing dollar scarcity in the market, and most of their costs are based in dollars. So it's not necessarily great for them to operate in this environment.
You know, at the MPC, the CBN governor did reel out some achievements through the 100 for 100 program, the RT 200 having brought about $3 billion as of June into the system. Are this not helping to ease the tension?
Yeah, so like the previous guest mentioned, it's the fact that, you know, most of these issues are cost related, and it will be very difficult, as we're seeing all around the world. You've seen, you know, hike rates by the Bank of England 5 times now, and you're still expecting more. I think they had already done that 25 basis points, but now everybody's talking about 50 basis points and 100, you know, and that's just because a lot of these problems are actually cost related, and the only way to, you know, solve these issues, as much as you have the monetary policy there, you also have the supply side, the fiscal policies as well, that have to work hand in hand, because you're talking about increasing supply of some of these products. The monetary policy cannot handle that. The only thing they can handle is, you know, more or less looking at inflation or policies that actually target, you know, inflation rate and GDP in any sense from the money side of things. But the physical side looks at, you know, actually boosting supply within the economy. So it obviously has to work hand in hand, and I don't think that's what's happening at the moment, because most governments, their hands are actually tied. There's no funding. Most governments are actually in debt, and it's actually increasing.
You're talking about state governments?
State governments, yes. No, well, not just state and federal.
Okay.
Yeah. Yes.
Yeah, okay. But in Nigeria, when we're talking about supply and then we're talking about non-oil exports, you know, and we delve to state government, I mean, we've been talking about our state government really maximizing the potentials, you know, of this non-oil exports. So we see the CBN bringing the RT 200 and talking to exporters, but are the states digging deep into, especially agriculture?
Yeah.
Although then we'll now come up with the issue of security.
Security and implementation. I think, you know, learning to more or less, you know, the rule book of how to actually pass on these policies to the day-to-day operations is very difficult, I think, in Nigeria. Most people don't actually understand the workings of how to actually translate these policies or implement these policies within the market. And I think that's actually the major problem. As much as there's lack of funding, you do have, you know, times when the CBN actually pushes, you know, funding out for specific, you know, and also the issue of corruption as well is still, you know, most people are not still talking about it, but corruption is still heavily a major problem within the country. I
think another problem, according to what the MPC noted, is the money supply that's coming from the political scene now. Yeah. I think that's also a factor fueling inflation at this time. And we don't expect it to abate, not until after the election.
Exactly, and that's, you know, you're looking at least first quarter next year, and that's, you know, is the inevitable, and it's the more or less the reason why investors are not coming in, because the risk environment now is actually quite heightened by, you know, the political scene, and also the fact that the policies when it comes to Forex is not necessarily clear for them.
You know, talking about Forex, so the aviation sector also has, you know, the repatriation order.
Yes.
You know, that's...
repatriation issues as well. That has also made, you know, operation of some of these airlines prove very difficult. We're talking about the domestic. Even the international airlines are also facing the heat. You know, you have some airlines that are overbooking. That has been, you know, a trend that a lot of people have been complaining about. And obviously that comes because they're trying to find ways to increase revenue in this particularly high cost environment.
Wow. I wonder where the lights will come in all of this, because, I mean, Nigeria cannot look at the US. US has its own. Yes. The US cannot look at the UK. But the UK is expecting recession soon.
Yes. Well, globally,
globally, I think
ECB
most countries... is supposed to hike rates. I think today or tomorrow or so.
But, you know, we're just in a peculiar situation at the moment. The same way we had the 2014 to 2009
because of the war in Ukraine? So would it have happened even if there was no war?
I think the war made it worse. If the war wasn't there, I'm sure by now would be more or less getting to levels, the pre-pandemic levels, which we had even seen before the war started.
In some sectors,
but the war has actually made a lot worse. The fact that Russia is a lot of countries are heavily dependent on a lot of commodities from Russia and Ukraine as well. And that is evident now in the world. And I think the West is trying to find ways and new policies to make sure that in the next few years, Russia is not going to be as important as it is at the moment, especially when it comes to oil. And even wheat as well.
But I think the World Bank or the IMF has said that there's no way any country can plug in Russia's oil and gas.
Well, it's like Saudi, you're right in that sense, because Saudi has actually come out to say 13 million barrels per day is their limit, is their max, you know, and to even get to that point, they have to, it requires significant amount of investment. I think currently they produce about 11 million barrels to 12 million barrels per day, and it's still not enough. And if they're talking about the fact that 13 million barrels by the world's largest producer, you know, amongst the OPEC allies, then it shows that achieving that point where Russia, they're not heavily dependent on Russian oil, is going to be difficult. And the fact that, you know, we're talking about electric cars and all of that, but it's not realistic in the sense that how would electric cars actually take over from, you know, petrol powered vehicles? It's going to be a difficult one. And even in Nigeria, using Nigeria as an example, we're not even able to power our houses with
the grid is down for the seventh time
exactly
this year.
So talking about electric cars is not coming anytime soon.
And then I wonder why we can't leverage gas.
I think it's, you know, lack of the knowledge there, the knowledge aspect of it, and the funding, and obviously the infrastructure as well is quite huge. I don't think it's something, you know, the government is looking at the moment.
Yeah, I think the MPC said they're looking at it, but I guess it's the investment that is needed.
The investment needed is quite huge. You know, they haven't even reached the investment peak for oil. Actually, the fact that we haven't even gotten exactly, so we're not even reaching that point. Talk less of, you know, getting to the point of gas.
Okay, well, let's look at commodities now. Cocoa is up 0.69% to $2,347. That's supposed to help us
with our export revenue. Yes, it should. Cocoa is up due to the fact that although we've seen, you know, increase in supply and reduction in demand, because, you know, most people are not necessarily, the demand is quite low. Chocolate is a luxury good. I don't think, you know, in times of high inflation, everybody is looking to spend on, you know, luxury goods like that. But at the same time, we had seen floods in Ivory Coast that had reduced or prevented transportation of some of the cocoa products to the ports. So that had obviously translated to higher prices.
Supply chain disruption.
Yes, supply chain disruption. So that obviously affected the price of cocoa. But I think Nigeria is actually taking advantage of it. We currently produce about 270,000 metric tons. And obviously at the end of this season, moving into the harvest period, we do expect that, you know, our cocoa production would actually increase, and we should benefit from these high prices.
Okay, at least let's have one good news.
Yes.
And then palm oil export from Indonesia is also set to soar.
Yes.
They've lifted their export, I mean, they were very strict.
Temporarily.
Yeah.
Yes, so...
they want to make some money.
Of course.
Everybody needs money.
Yes, of course. And, you know, we are, you know, major exporters and major importers of palm oil as well. And I think the current price of palm oil is about 20,000. It's down at the moment. So obviously that is good news.
But the bottle is not yet down.
Well, it's down in comparison to where it was, you know, a few months back. So that's
all right. It's good and bad. I guess that's the way life is.
Yes.
We just have to find a way to get through it. Bolanle Agbaji, analyst with Financial Derivatives Company, thank you so much for sharing your thoughts with us.
Thank you for having me. Thank you for having me.
All right. So now let's move over to one other market now, the equities market. Trading in the local bourse carried on yesterday's bearish performance. The all-share index declined again, even worse than the day before, 0.23% to close at 52,000 points. So notably, sell-offs in Nigerian breweries and GT Co undermine the markets. The banking counter has been getting a lot of, well, they always get attention when it's positive. Bargain hunting, they get attention. When it's a sell-off, they get attention. So banking was down there, 0.55%. But consumer goods, because of companies like NB, Nigerian Brewers, was down more than 1%. Industrial goods also down, and then oil and gas. And then, so let's move over to the fixed income space. That space is very interesting now with the MPR now at 14%. I wonder how investors are already reacting to it and what we expect. We have Caleb Alimi, who is a fixed income dealer with FSDH Merchant Bank now, to tell us what has been happening. Hi, Caleb. Good morning.
Hi, good morning.
Yeah, so I mean, I guess by now investors have started reacting to this MPR at 14%.
Yes, investors have actually been reacting to the MPR before now. In the last, say, few weeks, almost a month, market liquidity has been extremely tight. So we've seen that tightness in the market flow into, rates already. You could also tell from previous weeks how you've seen slowdown in activity of treasury bills, slowdown in activity of bonds. All of that has actually happened before the MPR was, raised by 100 basis points. Since the MPR has been raised, we haven't seen another leg of reaction, like I said, because some sort of event had already taken place to take, short-dated rates on bills, for example, to elevated levels around 10.5. That has already happened, before the MPR then moved to 14%. So we haven't seen another leg of reaction. The main reaction has been to the liquidity crunch that banks are grappling with at the moment.
Oh, okay. So do we say that investors have adjusted and this has already been priced into the actions before now?
It's an interesting way to put it. You could say it has already been priced in, but I'd like to say a reaction has already occurred, and then we've not seen the translation of the new 100 basis points hike. I mean, just 2 days ago, there was a bond auction where you saw yield move almost on the average of about 65 basis points. We saw the short-dated paper, the 2025, move from a 10.1% to 11%. And that was even before the announcement of the hike in the MPR. So we've seen quite a bit of movement already. It's fair to say it's been priced in, but I would like to say, a reaction had already occurred due to the liquidity crunch.
Oh, okay. So I guess the only thing that can move the market now would be a new stream of liquidity, I guess.
Yes, so if we get some inflows into the market, yes, we're seeing some inflows. Coupon payments have been coming in. Some came in 2 days ago, another leg that coming about today. So far, we've gotten about 100 billion into the market, but the market is such a huge deficit that that's not enough to even rescue the situation. We still need a bit more, say another 400 billion before market sort of stabilize. Then, it is improved.
Any prospects where that 400 billion could come from at this time?
Well, we expect a bit more in coupon payment and, of course, the monthly allocation that should come at the end of the month. The market often gets around the 300 billion. If that 300 billion comes in, and in addition to, say, another 100 billion in coupon payments, then we could, sort of zero out the negative that we carry. Barring any CRR debits, but if the CRR debits continue to occur, then, market will remain tight for now.
Wow. So we're back to that quiet market we had a lull for a while, at least until maybe FAC comes in, and then we expect some movement.
Absolutely, extremely quiet market has been, very few trading activities, and it's expected to continue for a while. Like I said, till that significant cash flow comes in.
All right. Well, we'll keep our fingers crossed. Maybe a miracle can happen and bring on unexpected liquidity to bring some movement into the market. Thank you so much, Caleb Alimi, fixed income dealer with FSDH Merchant Bank. Joining our colleague now in London, Juliana. Good morning. Well, all eyes are on ECB now. Our expectation is that, of course, as it's become normal now, there'll be a hike in rate. But there's also the issue of debt interest costs. So what are the conversations on how far this could go this time, and, of course, how it's affecting everyone over there, Juliana?
Oh, yes. Well, of course, Britain isn't a member of the EU, and of course, we're not a part of the euro. However, of course, everybody is keeping their eyes on what is going to happen at noon when Christine Lagarde and the rest of the ECB meet to hike interest rates. And of course, hiking interest rates has been the norm across the world over the past couple of months, but it hasn't been for the Eurozone. In fact, this would be the first time in 11 years that they have hiked interest rates. So the discussion now is just by how much and what is going to be the sentiment afterwards. I think earlier in the week there was a suggestion by Reuters that it could be hiked by as much as 50 basis points. So that's 0.5%, which is significant because they haven't done it in such a long time. And of course, there are so many issues that are affecting the bloc at the moment. I think the biggest issue has got to be the war in Ukraine and how that's affecting gas supplies. We just did hear this morning that Nord Stream 1, that huge pipeline that connects gas between Russia and Germany, has finally been switched back on after an alleged 10-day maintenance stop. I think that's going to ease pressure and perhaps could change how they decide to go forward. And then, of course, we've got the huge issue surrounding their third largest member state, Italy, and the fact that Mario Draghi, a former ECB president, has resigned, and potentially that government could be shut down. Inflation in the Eurozone at the moment is about 8.6%, although, of course, because there are so many members, 27, it does vary from state to state, and some are seeing inflation much higher. So yes, it is a big day. We are going to wait and see. European markets did open in the red. However, on the suggestion that interest rates could be hiked by 0.5%, the euro finally climbed to a 2-week high on Tuesday. So yes, we'll have to wait and see those famous terms, Innie.
Yeah, we'll have to wait and see, but I guess we are not waiting for too long, a couple of hours. We should at least hear and know what it is. But at the extreme weather there, you're in at this time. I know by Business Incorporated you'll be out there, but farmers are already talking about the yield and quality of potato and a possible hike in the price of chips.
Yes, it's a big story, and I don't know if you know, Innie, but Brits do love their chips. You know, it's not just the Irish. Brits do love their chips. And the British Potato Trade Association, yes, that organisation does exist. They have been raising concerns about the yield because, of course, we have been going through extreme weather patterns. The temperature's, you know, been up and down over the past couple of days. But we did see that record-breaking temperature, 40.3 degrees, the hottest day ever recorded in Britain, and it's significantly affecting regions in the southeast of England. And potato farmers there are saying that it is starting to affect the crop. Now, this has a knock-on effect because we know inflation is at fresh 40-year high, 9.4%. That was announced yesterday, wasn't it, by the Office for National Statistics. And fish and chip shops up and down the country are closing by about 20 to 30 each week. So 20 to 30 fish and chip shops are closing each week in the UK because of inflation. The extreme weather hasn't hit them just yet, but there are concerns that it is going to cost a lot of money for these fish and chip shops to keep frying those chips, which we know the Brits love so much. So yeah, so they've raised the red flag, but of course government is now in recess, so we don't expect there to be any intervention until the autumn.
That's not so good there, but Juliana, I guess we'll just be hopeful and guess that you Brits will get an alternative before things get back to normal. Well, we'll talk to you
maybe
again.
Maybe yam chips.
Exactly. We'll talk to you at 1:30. And of course, we'll be looking out at that ECB rate by then.
Yeah. Thank you.
Okay, so let's switch over to the crypto space now, where Ladi is standing by. Hi, Ladi.
Hi, Annie. Well, it's still extreme fear in this market, but we're still seeing, improvement, inching, back to that greed level gradually. It's happening gradually, but it's actually happening in the market right now because for the longest time, we're at about 10 to 12 points extreme fear. We even went below 10 points, at some point, but now
I think you had a little bit of setback yesterday at some point.
Yeah, and yeah, there's a huge setback this morning. We're seeing the price of Bitcoin actually tumble yesterday because the good old Elon Musk, again, back in the news, Tesla selling most of its Bitcoin holdings, and we saw that impacted the market. all those traders there, retail traders, follow that trend, selling off at this point, and we saw a pullback with the market cap by 4.48%. Volume traded is down also 2.45% this morning. Bitcoin dominance sits at 42.68%. Bitcoin was already playing over the $23,000 level yesterday, but now we saw that pullback. It's trading at $22,873 this morning, down 0.58%. We see volume traded $43.65 billion. Ethereum wasn't left out too. It lost that $1,500 mark. It's down 0.96%. Volume traded $23.47 billion. So we're seeing, pullbacks across the market with altcoins and Bitcoin. Once Bitcoin gets volatile, we'll see, the altcoins actually pulling back at the same time. All right, let's bring in Amari Suchet now, eCash creator, join us to have a conversation about central bank digital currencies. Great to have you, Amari.
Hey, good to be here.
Great to have you. So there is that debate about central bank digital currencies. Some are saying it's good for, financial inclusion, but some are also talking about risk. What do you see?
Yeah, I see this as a very risky move. Obviously, it's good for the central bank, but I don't think it's good for anyone else, really, even for the banks. The central bank digital currency give a level of control to the central bank that have never been seen at any point in history over the money, right? And we all know, like, money is pretty important. So that's a scary, that's a scary thought. Like, think about it. In April, for instance, in Nigeria, people were locked out of their mobile phone because of, various reasons by official. Like, imagine, they could do the same with your money. And not just with your bank account, but with money in general. Like, you cannot use money. That means you cannot pay your rent, you cannot buy food, right? So you're effectively a pariah. And you can be turned into one, like, without any due process really, and in no time, like instantly from 1 minute to the next. So, that's a power I don't think anyone should have. That's a very dangerous power.
But with fiat, the central bank still has control. They can also, shut you out from, bank accounts and all of that. But the central bank digital currency...
Well, you can use... Yeah, sorry.
Yeah, you can carry on.
You can use cash. You can use another bank, right? If you are excluded from the CDBC, that's done. Like, you cannot use anything else.
So at some point, fiat and CBDCs are supposed to, work together. Are you saying at some point we won't see fiat anymore? It will just be central bank digital currencies?
Yeah, at least that's the goal from the, central bank's perspective.
But is that actually achievable? Is it achievable?
Whether the public accepts that or not is remains to be seen. But, this is where this is going. And we already see that in some country like China, for instance. So, the Chinese people, they let it happen, or maybe they didn't have a choice because, China is not so democratic. So this is happening in China. Now, it's up to us to decide, everyone in their own country needs to decide if they want that to happen. But I don't think this is a good thing for freedom in general.
But right now we're seeing, struggle with adoption of central bank digital currencies. Most citizens are not using it as, the central bankers would actually expect. Do you see that changing at some point?
Yes, it's... money is tied with people's habits, so it's going to take many years. But, government and central bank are very patient. They can move that, step by step over the next 10 years or even 20 years. And, so for instance, from the time we went out of the gold standard, it was in the 70s, right? To the time right now where we see interest rate that goes through the floor, even negative and crazy inflation cycles and stuff like that. It took almost 50 years. And people in the 70s, they were warning about that when we went off the gold standard, and nobody took them seriously because it didn't happen immediately. But, eventually this is what happened. Central banks, government, this kind of institution, they have all the time in the world, right? But you need to be thinking, especially if you have a family, right? You need to be thinking about the world that you're going to be living in. And, if we are not concerned about that, our children, they won't have the freedom that we do. We can see in some countries like Sweden, for instance, cash is almost gone. Yeah, like you cannot pay in most places in cash in Sweden.
Right.
And this is going to come to more and more countries over time, unless, you know, we push back against this.
Well, the evolution of money continues at this point. It's been interesting to see what money will be like in about, say, 20 years. Thank you so much, Amari Sachet, eCash creator. All right, so you heard it there. It's some see risk, you know, when it comes to central bank digital currencies. Some see benefits there, but that debate still, you know, carries on, you know, in the crypto industry, because at the end of the day, Bitcoin, you know, brought about central bank digital currencies anyway.
Yes, it did. And as Amari Sachet has said, it does have its own downside also. Imagine the central bank just locks you out and there's nothing you can do about it.
Yeah, you can't get any cash or digital money.
We'll certainly see what the future of money looks like.
It'll be very interesting to see.
All right, Laddie, thank you so much for that. That's it on the program. But Laddie will be back at 1:30 p.m. for Business Incorporated to give you updates from the world of business. I will see you tomorrow for the final episode of Business Morning for this week. I'm Ini John Mekwa. Enjoy the rest of your day.